a lot of lenders are being shopped around more frequently. You don't get as much of the loyalty from the buyer like in a buyer's market, because in a buyer's market everything sounds good. So you don't really want to go through the headache of reapplying with a bunch of different lenders, right? But in this type of sensitive market, like I think a lot of the buyers do apply with multiple lenders. So the lenders just don't want to eat costs.
And then I know we definitely wanted to educate them on the down payment.
Yeah, so down payment, obviously, like I think a lot of buyers that I talk to are very confused when it comes to dividing or separating closing costs from down payment, because when we speak of it in terms, as lenders know that closing costs is separate from down payment. Down payment is what you need to put into the loan based off of what is required by a program. So unless it's 100% financing, which isn't really a lot of options, conventional loans, FHA loans, they all have like a minimum down payment requirement. VA loans obviously is 100%. So unless you want to put money down, it's not technically required.
Right.
But a lot of times the loans will be like, hey, you have to put 3.5% down, or you have to put 5% down, or 3% down. In that case, the down payment is not going towards the expense or the cost of buying. Technically, it's going towards the equity. You're basically putting that money into your own house, right?
Right.
But it's just a requirement for certain programs, so you have to do that in order to get the financing.
Right.
So like I said, FHA, the minimum down payment is 3.5%. So you would have to put 3.5% of the sales price down. So if the house is like $100,000, you would have to put the $3,500 down, and that would be something you walk into at the end of the day. So when you close on the house, that is money that is still in your house.
So was that what, 96.5? Yeah, 96.5.
Yeah. So you basically have 3.5% of equity in your house, right?
Because you put it in there already.
Right.
So it's basically investing in yourself.
Right.
Essentially.
So that's separate from closing costs, which closing costs is the cost to actually obtain the financing and obtain the house. So closing costs is bundled up in different types of fees. So you have to pay everybody who is providing you a service a fee, right?
And this is one of the things that I try to always talk to my clients about. That's why I have the preferred lenders I have. That's why I have the preferred title companies that I have, because everybody's fees are different.
Yeah.
And this is where the back end does matter, right? Because every lender has their own fees. Every title company has their own fees.
Yeah, and certain programs cost
certain
different
fees too.
Of course.
So I don't know, I have a video that I did recently about doing first-time homebuyer programs, because a lot of people talk about those 100% down programs. I get it. If you want to get your foot in the door, because I just need you to kick in the door first, and your first home ownership door, right? We need that first door. It's great for people, but it does cost a little bit more. There is cost associated, maybe not up front, but on the back end.
Yeah, of course. And I think that's something that we probably will talk in
depth later. In depth
in one of the categories where we'll cover more so like points, I guess.
Yeah.
Or like leisure credits or that type of stuff. But the closing costs generically is basically like origination fees, right? So origination fees is if you're working with a lender, their company will charge a certain amount, and it can be like a flat fee. So they can charge, some lenders will charge like $1,000 to, do all the processing and the underwriting and all that, right? And origination of the loan, which is basically the first step. They have to structure it. You have to get pre-qualified. So that takes the work into doing that. And
or
then
1%.
Yeah, or other lenders will charge it as a percentage. But of course the percentage, there's protection against the buyers. They can't just charge whatever they want. They have to charge within the margin of what is allowed, because if you charge too much in closing costs, then it all of a sudden becomes a different category of loans, and it's not within the guidelines of a qualifying mortgage.
Okay.
So closing costs, origination fees. So basically what your mortgage company is charging you, or your loan officer, the bank that you're going through is charging you to originate the loan, process the loan, that type of thing, review it.
So real quick, before you go a little bit further into that, because another thing, you're using the terms loan originated. Can you just kind of expand?
Yeah, so origination is when you go and talk to a loan officer, or when you apply or submit an application for financing, what they have to do to break your profile down into qualify you.
Okay.
So that's origination. So getting your income, your assets, your credit, and reviewing all of that and verifying that information, that's origination.
Okay.
And then processing, of course, is another section of the loan approval. So there's departments that it has to go through. So all of that is bundled into that cost of origination. And sometimes they will break it down for you. It all depends on the company and how in depth they want to go with these fees, but usually it will be bundled into a percentage, 1% or a flat fee, or they'll break it down and say origination 500, processing 500, or something like that, right?
Right.
So you just have to keep an eye out on that section, because the sections are broken down where you can see where and who is charging you, right? So origination, a mortgage company, whatever, is going to charge you the origination fee, the lender fees. Another part of that is the title side, the settlement company. So that's who is going to be preparing the title of the property you're interested in buying, right? That is recording fees, taxes, all of that setup. That's going to be done by the title company, but that's also associated with the fees, the court fees or the county fees.
And those are more your set fees though, that you can't really change.
Yeah.
Taxes and whatever the county is charging, the courthouse is charging for their processing fees. The only fees that could probably
be adjusted
change
or different is
adjusted,
the actual title fees.
Yeah,
so any service
fees
that is being provided.
Yeah.
So property taxes, recording, all the state tax, county tax, deed recording, all of those are pretty much fixed expenses, but there are, anytime a service is being provided, so a person is doing work for the loan, that is a charge that can be adjusted. That is controlled by the company of whoever you're going through. So it would be if you're going through Cardinal Title, they have a set settlement fee or a processing fee, and you would have to pay that. And that would be for them to have somebody at the settlement table going over everything and notarizing everything, and then people in the back end who is putting that title package together. So that's what fees you're paying for. But then they have to do work getting the deed and recording and all of that, which is associated with the cost that they don't control.
Now I know too, you do have an optional fee, which is title insurance.
Right.
However, I don't know why it's optional. I always say get it. I always say get it.
Yeah, so
because it's better
title
safe than
insurance
sorry.
is broken into two categories.
Right.
One is optional, one is not. So the lender's title
is not
optional, because that is required in order to obtain financing, because that protects the lender.
Correct.
Whenever the property were to have a lien against it, or go into default, whatnot, or have any legalities against the property, that's the title insurance that the lender requires, so that they can give you all this money, right? And the owner's title, that's optional. You do have to know that though, as a buyer, that you do have the option to opt out of it if you don't want it, if you don't want to have an expense for it. But it is an important part to take the property and analyze the property as itself and see if it is going to be a necessary option or a smart option. Because I feel new builds, most of the time, the title insurance for the owner might not be as necessary. So? Yeah, because what is the history of that property?
Yeah, but it protects more than just that, because if that company decides to pack up and leave and someone put a lien against the property because they didn't finish paying a contractor or something. I mean, instead of you paying a lawyer, which is going to cost you in this area on average about $400 an hour, you have the option of utilizing your title insurance, right?
I think that's
well,
something.
if you get enhanced, I mean.
Yeah, true.
So
I guess, like I said, I think it's more for you to look into. I mean, we can probably dive into title insurance.
That might be good. Maybe we need to bring a title lawyer to talk more about the differences, because to me, I just think it's better and it's safer to pay the $1,000 up front than to have to pay it on the back end. You don't know what comes with it.
Right. And I agree with that, because it's kind of, I feel like insurance is kind of like also psychological. It's like whenever you like have insurance, I feel like not much happens. But then it's like when you don't have it. Correct. Like everything and its mom happens to
Exactly.
you.
I just like the peace of mind. I just be honest. I like the peace of mind. But then even with the other costs associated, I just feel like it's $1,000. Like this is a overall investment.
Oh yeah,
you know
for
what
hundreds
I mean?
of thousands of dollars. I mean, it's very
it's $1,000. I mean, $1,000.
Yeah.
I mean,
for protection.
I don't see it any other way. And then, I mean, you do have other closing costs, with starting up the escrow. And I like to tell people, just think of it as like a savings account.
Yeah, so escrow basically is whenever you put, usually if you put less than like 10% down, I would say, to be safe, you have to set up an escrow account. It's mandatory. Of course, there is certain situations where you can waive it, but that means,
what, I didn't even know that. So
that means you have to put more down. So like typically, like how if you put 20% or more down, you don't have to pay mortgage insurance. It's very similar to that. So you can waive your escrows, and sometimes lenders will let you do it like in certain cases if you do 10% down, but if you put more than 20% into it, you can waive it. You can set it up separate, so that means you're not paying your homeowner's insurance and your property taxes out of your mortgage. You're paying that separate, like you're going to be responsible for it. But a lot of people don't like to do that. It's more common for people to set up escrow because you get to pay one mortgage payment and you don't have to worry about paying like multiple separate things.
Yeah.
So your mortgage payment, in order to set that up, that your taxes and your homeowner's insurance is included in it, is you have to set up an escrow account, which means you have to pay an X amount of months in advance as part of your closing costs to set those accounts up. So they're basically holding it so that in case you miss a payment and stuff like that, they have that buffer in that account to replenish or to make sure that you're not going behind on taxes or your policy isn't expiring.
Now, side note though, let me
Side note? Why is it sad? Why are we sad?
It's on the side note because how do y'all feel as lenders when we pay our entire premium for PMI and not the full 20? Because that's usually what I do. That's usually my advice. I don't pay the 20%, right? I just pay what they're gonna let me have with my good credit, and then I just pay the PMI premium. I call it a day.
Oh, you mean like upfront?
Upfront.
Oh yeah, so that's a part.
Cheaper.
That's a part of the cost too, and I would only really recommend that if the person has like a good credit profile, because if you don't, that upfront is gonna come. That rate is gonna come in really high.
Okay.
So that can add a lot of cost to your.
But isn't it cheaper than 20%?
It all will depend though, because
maybe because I got good credit.
Yeah, but if
come on, get your credit up now.
Flexing, but
flexing.
Yeah, but it does depend on your credit though. A lot of the charges do depend on your credit, like not just your interest rate, but like the rate that you're going to get mortgage insurance depends on your credit. So if you don't have a good credit profile and you want to pay it up front, you might be paying like double somebody who does. So that could be like over $10,000 or whatever for the property, and you might not have that, to put extra into like your closing costs, right? So that's why usually you can compare it. You can say like, oh well, it's going to cost you like $4,800 to pay it up front, or if you don't have really good credit, it could cost you $12,000. So you don't, and you might not have the option to pay it up front because like I said, we have to put it in that bundle of costs So you can't have, like, you can't be paying like 9% closing costs, you know, because that disqualifies that mortgage as a qualifying mortgage. It is now in a section called higher price mortgages.
Girl, we getting technical.
Yeah.
I ain't know my questions don't get like that.
Yeah, but there's so much. There's so much. But like I said, there's a lot of rules, and obviously, like, you're not.
That's why
you don't need to know
lender.
every single rule. You just need to know you work.
I need to know every single rule, because even though I'm not a lender, I just like to be a lender in the back of my mind, so I know how to guide folks a little bit. So so when they get to y'all, you know, they're prepared.
Yeah. So, but
you know,
like generally closing costs though, like there is a rule, you can't go above a certain amount. But those lenders, like the escrow account, that is basically a year's worth of homeowner, like your policy, like your homeowner's insurance, you're paying that in advance. Because you know when you set up a car insurance too, like you have that annual premium, right?
Mm-hmm.
Like you can pay it for the year. You're not paying, usually you're paying for insurance like before you get the insurance.
Mm-hmm.
Like you don't pay for it after you know, use it.
That's a good way to put it. Absolutely. Yeah. So all in all, the closing costs that you're paying for at the table is going to be your lender fees, which you already discussed, your title fees, and some of those fees are going to be fixed fees, and then some of those fees are going to be service fees, whether it's for lender or title. And then you're also going to have your escrow fees, which benefits you as the buyer. That's going to be for you to be able to pay your mortgage
with those included.
And then it's going to break down your what we call PITI.
PITI. What does that mean? Principal, interest, taxes, insurance. That is what makes up your mortgage.
Principal, interest, taxes, and insurance, and they're going to pay on your behalf your taxes and your insurance for
so you don't have to worry about it.
So you don't have to worry about it. All right, y'all should be able to follow that, because I know we all over the place. But just know you can always rewind, and pause. Take some notes. Get your
or you can just ask.
Or you can just ask, right?
Basically, credits are. Credits is another section that we'll see after all of like the costs, and we call it credits because it is going towards